have a really, really, really famous example of correlation and causation and covariance here. So this is a time series chart. So on this axis here is time, and these two pieces of data come from the same time period, and this is a 2-month period, June and July of 1984, 40 odd years ago. Okay, so notice a couple of things straight away. As one goes up, the other one goes up. As one goes down here, the other one goes down. The blue one here goes up a little after that, the red one goes up. And then they both seem to come down. The red one seems to sort of bow like this, and then the blue one sort of bows like this. Okay. So given these are occurring at exactly the same time, can we make any claims about A and B? So the first thing we can suspect, does A cause B? In other words, A, the blue one going up, does this sort of drag the red one up with it? When the blue one goes down, it's pulling the red one down with it, and vice versa. That's one option. The second option is, does B cause A? So this is the exact opposite. Is it when A goes up, it causes the blue one to go up, and when the red one goes down, it causes the blue one to go down? Is that what's going on? The third option, are A and B being caused by, let's say, C, some other force that's pulling both of them up and down? So they're not necessarily related to each other, but something else is pulling them up and down. Fourth option, I'm going to put it down here, is that it's just a coincidence. Okay, so let's run through it again. Does A cause B? Does B cause A? Are A and B both being caused by something else? It's just coincidence. I won't expect you to stop the video because no one ever does that. All right, what do we need to know? First thing we need to know is, what are A and B? It's a really good place to start. So let's have a look at what A and B actually are. A is the Dow Jones Industrial Index in New York, Wall Street in New York. So you must have seen this on the news. Whenever shares go up, it means that the share brokers and the Wall Street people believe that the American economy is going really, really well. They think the company is going to make profit, so they want to invest in those companies. So when they're feeling good about the economy, feeling good about companies, the share price will go up. Conversely, when they think that the companies are not going well, the economy is not going well, they'll tend to disinvest, which means the share prices will go down. All right, do we have enough to make a claim now? Let's have a look at our setup here. Given that A is Wall Street, Can we now say that A causes B? So Wall Street moving causes B? Can we say that something else is causing Wall Street to go up and down? Can we say that A and B are being caused by something else? Or is it a coincidence? So the answer is none of them, because we need to know what both of them are. We need to know what A and B are in order for us to make any kind of inference, in order for us to make any sort of call. So what is B? And again, this is a real example. So B is the number of rabbits in a field in North Dakota. North Dakota is a very rural state in the north central United States. So they have someone there who has the best job in the world sitting in a field counting rabbits. So whenever he sees a rabbit, he'll do like a little tally mark. There's one rabbit, there's another rabbit, and so on. So now we know what A and B are. Can we make some kind of call? Can we say that Wall Street causes rabbits? Can we say that rabbits cause Wall Street? Can we say that rabbits and Wall Streets are caused by something else? Or can we say that it's a coincidence? We can pretty much be pretty confident in saying that it's a coincidence. Right? In statistics, unless we have good evidence otherwise, we're going to presume that it's a coincidence, that it's just randomly linked. You have to show me the body. Habeas corpus. Show me the body. All right. Let's look at all of them separately. All right. If A causes B, so in other words, the Dow Jones Industrial Index is causing the number of rabbits to go up and down. And it is a positive correlation. So Wall Street goes up, the number of rabbits goes up. Wall Street goes down, the number of rabbits goes down. What would need to be true in that case? Well, that would mean that the rabbits are really keen investors. They're sitting around watching Wall Street on the tickers coming through in their little holes in North Dakota. And when they see that the stock exchange has gone up, they leap out of their holes, jumping up and down in manic rabbit glee that the price of carrots is going to move. They're going to be rich. Everything's good in the world tonight. Is that true? Probably not. Rabbits don't tend to invest in the share market. They tend to invest mainly in foreign exchange and bonds. Okay, let's look at B. Does B cause A? So, in other words, is the number of rabbits in North Dakota affecting the Dow Jones Index in New York? What would that mean if that were true? So this is an argument ad absurdum. That would mean that the people in Wall Street have some spotter sitting in a field in North Dakota. Whenever he sees a rabbit, he gets on the walkie-talkie, gets on the backphone, pulls up Wall Street, and all the share brokers go nuts, start jumping around with glee, popping the champagne, buying shares, just laughing around, jumping into bushes, having a great time buying shares. When they don't hear from the guy standing in the field in North Dakota because he hasn't seen any rabbits, they get really depressed and they start popping the champagne but drinking a lot more of it, feeling really down, selling all of their shares, and the price goes down and the Wall Street Stock Exchange goes down. Are share brokers taking stock tips from rabbits? And the answer to that is probably not. Share brokers are crazy, but they're not stupid. All right, the third option. Are A and B being caused by some other event? And if you think about it, this is not as hard to dismiss. So, what would that mean? Well, let's say the third event was, what if it's really, really sunny? It's really, really sunny, and the share brokers look out the window, see that it's a nice sunny day, and the rabbits look out of their burrows in the morning, see that it's a nice sunny day. The rabbits decide to go dancing in the fields, and the share brokers decide to buy shares. It's plausible. It's unlikely, but it's a bit more plausible than the other one. It's unlikely because this is a 2-month data set, and North Dakota and New York are a long, long way away. So it's unlikely that every single day it's going to be sunny in North Dakota and sunny in New York. And it's in June and July, so most days are going to be sunny anyway. Okay, so it's probably not the weather, but it's kind of plausible. What might else it be? Well, what if the rabbits and the share brokers are good, patriotic Republicans? There's Republican rabbits, and they see Ronald Reagan making a great speech on TV, and the share brokers think, yes, the economy's going to go. And the rabbits are thinking, yes, the price of carrots is going to drop. We're going to be rich in carrots. So the share brokers start buying things with reckless abandon, and the rabbits start dancing around in the field. So they're both being caused by something else. Unlikely. Possible, but very, 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 very. Alright. We should be making a leap now that it's probably. So, in statistics, we presume that events are random unless we have good evidence otherwise. Right? You need evidence. You have to know what's being presented. The Latin phrase habeas corpus means show me the body. So our null hypothesis, H0, is always going to be there is no relation between things. Unless we have good evidence, we're not going to reject the null hypothesis. Okay. Let's look at a sort of slightly different example. So in Scotland, in the north east of Scotland, in Loch Ness, the claim is that there is a giant sea serpent or some type of monster. See, I'm not an artist. Swimming around Loch Ness. What evidence would we need to reject the null hypothesis that there is no Loch Ness monster? It certainly wouldn't be some grainy photo from 80 years ago or some tourist who's had too much Scotch whiskey while he's up there, who thinks he kind of maybe sort of saw something moving in the water. That's not good enough either. We would almost literally need to say habeas corpus, show me the body. We would need the body of a great big huge monster in order for us to reject the null hypothesis. Right. So now we get to the formal bit. What is covariance, coincidence, and correlation? So covariance is when we measure two variables. So in this case, it would be the rabbits and the New York Stock Exchange. And we test whether they tend to move together. So in other words, when one goes up, the other one goes up as well. When one goes down, the other one tends to go down as well. It doesn't mean the one is causing one, it just means that they're moving in the same way. So there's two types of covariance, or two extremes of covariance. There's positive covariance, which means that when one goes up, the other one tends to go up. When we have negative covariance, when one goes up, the other one tends to go down. And vice versa. When one goes down, the other one tends to go up. Let's compare that to correlation. So correlation is a more sort of formal test. So correlation is a sort of scale. We put a formal mathematical algorithm. We're not going to get into that right now, but we're saying how strong is the relationship between them. So this, if we had some, oh, what's that? If we had that, this would be a pretty weak correlation. And this would be a pretty strong correlation. When one goes up, yeah, it goes up just as steeply. When it goes down, it comes down just as steeply, up just as steep, down just the same. That would be a really, really good, strong correlation. So that is not causation. You will see this again and again and again. So get this tattooed to the inside of your eyelids. Correlation does not equal causation. Just because two things are happening for a limited time anyway, doesn't mean that one is causing the other one to happen. So the proof of that is actually in the example that we used. If we had a look at it from a longer perspective, or actually afterwards, they're both almost sort of random. And it just so happened that with that very, very small point in time, they tended to match up. So we had a look at this tiny sort of period of time, but as time goes on this way, as time goes on this way, there's no correlation. The share brokers are not talking to the rabbits. The rabbits are not investing in IBM. And it's unlikely that rabbits would vote for Ronald Reagan anyway, although he is Ronald Reagan.